Welcome back. Well, the bank Nifty is now moved back into the green, and the Nifty, it appears that buy on dips really is playing out because the Nifty is back up towards the high point of the day. So pretty good going out there. But as promised, let's get chatting with the management of RHI Magnesita. They raised close to 900 crores via the QIP route. Now, with the help of these funds, the company plans to modernize some of their operations, capitalize on the opportunities as well in the refractory market here in India, as well as West Asia region. Mr. Parmod Sagar, the Managing Director, as well as the Chief Executive Officer at RHI Magnesita, joins us on the show. Hi, Mr. Sagar. Good morning. Thanks so much for joining in. Good to speak to you actually after a while. Now, you had taken a board approval to raise close to around 1,500 crores. You have done a preference issue of around 200 crores to the promoter entity, a QIP of close to around 900 crores. So 1,100 crores done. Will you be looking at raising further money via equity? And also, if you could tell us, what will this money be used for?
Okay. So we have taken an approval from the board and as well as our shareholders for 1,500 crore, but we thought we will be going for 800 to 900 crore, which our paper also shows. And we very fortunately got almost 150% subscription, but we stick to 900 crores thanks to our investors who have got a faith on our company. 200 will come as preferential from the parent company, which also shows a lot of confidence on the local management, local company. We don't have any plan to further raise.
Okay, no plan to further raise any more equity. That's good. And what you're going to use this money for? Close to 1,100 crores. Repay debt? If yes, how much?
Roughly 750 will be repaid. We had a bridge loan. So 750 will be paid back as and 300 crore roughly we are going to use for modernization of plants which we acquired from Tata Group. And 300 crore is regular capex.
Okay, so 300 crores you'll be using for modernization of the plant and 300 crores for regular capex. Any inorganic acquisitions that you have planned?
Our strategy is to grow inorganically. We did this in past years, and I would not say no. Yes, if the opportunity will come, it will not be as big as we did in last few months. But yes, we can do it.
Okay. So when you say we can do it, anything that you have earmarked, any kind of number that you're looking at? I mean, how much is the amount that you have set aside for inorganic acquisitions, and would you be looking to do it in this calendar year itself?
Nothing is on the table, frankly speaking, but if something comes up, definitely we will do, but it will be in the range of, say, 150 crore to 250 crore, not more bigger.
All right, so that will be small if in case you're going to be doing that as well. I think Sonia is asking that because you've done such a big dilution. You've done a QIP, you're doing a pref issue, you're also issued shares to Dalmia. So just wondering why you're so wary of raising any debt. Talking about that, you're going to be repaying 750 crores of a bridge loan. So post that, what is the debt in the books?
It was about 1,300 crore roughly.
Yes.
And we were not very. Actually, we are not independent company. We have a global company also, and global company has a lot of debt in their balance sheet. And this debt is also going to sit in their balance sheet, which is not good. So we decided to go this QIP way.
Indeed, it was a very big equity dilution. I get the point. The parent could be a little bit more leverage, but the debt in the listed entity here in India, it'll be around 550 crores post this repayment.
It will be like this only.
550 crores. All right. I want to ask you about a couple of acquisitions then. On the Dalmia refractory business that you picked up, you were telling us that it's functioning at around 55 to 60%. You're looking to ramp it up, and also you're looking at upping the margins. So give us a couple of numbers. What will the margins be on this asset in FY24? You had said you're going to take it to mid-teens. So could you confirm that? And also on this asset, I think earlier you had drawn out a capex of around 300 crores. But that number was up, right? What is the updated number? Margins and capex.
Number is same, and it is so early to give any number about the margin and all. It will take probably 4 to 6 months time to really ramp up the thing, improve the productivity, reduce the scrap rate and all. But I can say the number will be in double digit at least.
Okay.
Margins.
All right. In double digit margins is something that you're looking to hold on to, right?
Yes.
Okay, got that. Can you tell us what is the plan on Dalmia's holdings in RHI? I mean, will that be some kind of a overhang? Because I think they have about 14.3%, if I'm not wrong, as per January data.
Absolutely. Absolutely, but I think Mr. Dalmia is the right person to ask this, whether they will hang on or not.
No, the worry is, Mr. Sagar, the worry is for your shareholders, right? Because such a big holder will have 14%, and I think the lock-in will expire in July or August.
30%. Yeah.
So what happens after that? That's what, that's why Sonia asked you that.
We have not discussed with the Dalmia Group as of now, and we understand they can dilute a little bit there, but I'm not sure really. Sorry, I cannot give the right answer.
All right, interesting. Now, because on their con call, they have said that they want to exit all these non-core businesses. So that's why the refractory business has moved out of the listed entity as well. What about on high tech? The margins out there were much better when you acquired it, I think 27% odd. But what is the sustainable margins for that particular asset that you acquired?
I think 20 to 25% should be the sustainable one.
That's a very wide range, sir. 20-25%. Will it be closer to 20 or 25%?
I should say in between.
In between, okay.
Okay, in between 20 to 25%. Got that. Overall, for your growth, what are you targeting? I mean, you've done about almost a 20% growth in the quarter gone by in Q3. Do you think that is a level that you can sustain in FY24? If not, what is the average growth that you're looking at?
We are in a blackout period, so I cannot give a number, but I would say that the revenue should be double in this financial year from the last year.
Right. Give us further numbers, sir. Now you'll have both these two assets consolidating. High tech, I think, will add close to 250-300 crores, I think, in terms of revenues.
Right.
Dalmia, I think, at optimum levels, I'm guessing it could do around 1,600 crores. So you're currently doing around 2,000. What is it, sir?
Not really. Dalmia number should be around 1,200 crores. 1,200
crores for this year, but I think peak levels are around 1,600 crores. So for FY24, 1,200 crores from Dalmia. High tech should be around 250 to 300 crores. And you're currently going at a run rate of around 2,400 crores for the year. So if I add all these three numbers, you should end, FY24 with a number of close to around what? 3,800, 3,900 crores approximately? Closer to 4,000 crores?
4,000 crores.
4,000 crores for FY24. And what kind of margin should we look at for the consolidated entity? That's the existing entity, plus you'll get both those two assets. Dalmia, which is margin a little bit lower, while high tech is better. So consolidated entity, what should margins look like?
14 to 15% should be sustainable margin.
All right. And your market share currently is around what?
It is about 30%.
30%. Okay. All right.
Yeah.
Okay, we will leave it at that, sir. Thanks a lot for joining in and speaking to CNBC-TV18. By the way, the market is picking up some more pace, so just take a look at that. The Nifty is now up almost 50 odd points, about 0.2% higher. And the stocks that are leading from the front, Godrej Properties, definitely very strong commentary from the management and very good sales numbers. So that stock is up 8.5%. Tata Motors, Credit Access, Grameen are the other stocks that are up about 5 to 7% based on both numbers as well as the brokerage positive commentary. So lots of big buzzers in trade. But Q4 earnings season is here and it kickstarts this week with TCS reporting their numbers on 12th, Infosys on 13th. Rima is joining in now with the key expectations. Rima, over to you.
Thanks so much for that. So this is going to be one of the trickiest quarters to lay out expectations, considering that we are in a heightened period of uncertainty. Just look at the broad divergence in expectations. So for instance, for TCS, the range of the constant currency quarter-on-quarter revenue growth ranges from 0.1 to 1.7%. For Infosys, it goes from minus 0.1 to 1.1%. But look at the numbers for HCL Tech. Now, CLSA is expecting a degrowth of 2.9%, but Nomura is expecting a growth of 1.1%. So the expectations are all over the place. But as you can broadly see, the growth this quarter is going to be lower than the prior quarter. Q4 less than Q3. And the key reason for that is the banking crisis in the US regional banks and the European banks may have induced greater caution, impacting the overall tech spends by banking clients. And plus, typically, March is a seasonally weak quarter. Now, the margin performance amongst large cap is also likely to be more divergent. Now, for TCS, we're anticipating about a 50 basis points margin expansion, but for HCL Tech, margins could come down on a quarter-on-quarter basis. The key is going to be the FY24 guidance. And here we're anticipating Infy to be conservative and guide for a 6 to 8% revenue growth, constant currency revenue growth. But this will be lower than the 16% odd that they clocked in last year. That's FY23. But Infy is Infy, so we're expecting them to be fairly conservative. For HCL Tech, again, it's very hard to get a consensus this time on guidance, but it looks like it could be a mid to high single-digit kind of growth because you've got a minimum of 4 to 6%, and you've got some analysts even going up to about a 10% growth. But both HCL Tech and Infosys are likely to range the upper end of their margin guidance. These are the numbers. For Infosys, 21 to 23% versus this year's margins at 21 to 22%. So the upper end of the margin guidance is likely to be raised. Now let's quickly run you through some of the brief and quick expectations of what we are going to be watching out for. 1, the extent of impact due to the global banking turmoil on deal wins. 2, retail, high-tech, Europe. These were flagged off as some of the weak pockets in the prior quarters. Does the weakness continue this time? Will normalcy return in the second half of FY24? Because what analysts are penciling in is that H1 is going to be weak, but things pick up in the second half of the year. Company-specific TCS is eligible to announce a buyback. It's eligible, but will it do so? Leadership changes have been announced right at the top for TCS and Tech Mahindra, so they will take center stage. And any change in priorities, strategic direction, new appointments as well, right under them. Now, TCS has to announce a new BFSI head. The COO, Chief Operating Officer, will be resigning or retiring next year. And finally, on deal wins, are we seeing a delay in deal ramp-ups? Are sales cycles getting longer? Is there slower revenue conversion? So all these are some factors that we will be watching out for. And finally, considering that the IT stocks have seen a bit of a correction, the valuations now are pretty much what they were compared to their 5-year average. So are they pricing in the uncertainty, the uncertain environment that we're currently living in? Back to you.
Okay, thanks a lot, Reema, for that. Let's pose that question to Apurva Prasad, who's been tracking this sector for ages now. He's the analyst at HDFC Securities. Apurva, it's all up in the air, right? I mean, nobody knows what these companies are going to speak about, considering that growth is slow. Client spendings could perhaps be, under a bit of pressure. But Reema was talking about a 6 to 8% FY24 guidance from Infosys. Is that something that you are expecting as well, or could it get worse than that?
Hi, good morning, Surya. So we do expect it should be in that range. In fact, we believe that the band could probably be a bit wider. So it could be something like a 5 to 8%, looking at the current uncertainty. But let's not forget the historical relative conservatism of Infosys. So meaning, if you look at historically, what's the first guidance been and where they've ended up for the year, typically tends to be higher. So I'm saying 6 to 8 is probably where I believe consensus expectations are. 5 to 8% is, I think, is possible guidance.
All right. Hi, Apurva. Good morning. Thanks so much for joining in. Well, for the sector on the whole, I think now valuations have traded to sub 1 standard deviation. How much of the bad news is already in the price? Would it be constructive from here on?
Yeah, Nigel. So I think we should be more selective from here on. So it is certainly less than 1 standard deviation. So a lot of risks are, to an extent, priced in. We have slightly moderated our growth estimates. This is more near term, so Q4, Q1. We do expect a sequential pickup beyond that. And at the same time, some of the factors that we're looking at while we're being selective is high line of sight of growth, the probability of outpacing near-term expectations, and the magnitude of growth. So based on that, I believe one needs to be still a lot more selective. At the same time, with valuations that has corrected on a relative basis, I mean, the sector was at 40-50% premium to Nifty, and it's a lot lower. It's more like long-term averages, even if you compare valuations with the Nasdaq, and if you also look historically what it's done over the last 20-year period, interestingly, Q2, which is the September quarter, it accounts for about 50% of the sector returns. So we're getting there. Q1, which has traditionally been stronger, we do have a lot more macro headwinds. So I think being selective is a stance that we continue to recommend.
For TCS, what is your expectation? Of course, apart from what they talk about the earnings, etc., all eyes will be what the priorities are under the new CEO and the continuity of the current organizational structure. I think that's what the street is looking out for as well. But for shareholders, what should the primary objective be this time around?
Yeah, so from a quarter standpoint, we expect a modest 1% sequential growth, which within the tier one they should be the highest. We do expect them to improve their margins by about 50 basis points. So the run rate that they do intend to hit by the year end is I think that's likely to continue. I think sort of leadership transition, more commentary around that, how the org structure changes is likely to play out. I think these would be some of the important factors. Apart from commentary on some of the core verticals, TCS being sort of having a higher exposure in that. So I think commentary around BFSI and some of the core geographies, because we've seen some kind of a divergence even in the commentary of core geographies. So North Am versus Europe, I think these in any case would be important.
All right, you're expecting a sequential degrowth for a couple of companies, right? Large cap IT. Could you tell us which one are those?
Yeah, Nigel. So that's HCL Tech. It's partly a bit of seasonality. So Q3, the PNP business normalizing. So it's HCL Tech and Wipro. So it's slightly below the bottom end of their quarterly guidance. The two companies where we expect constant currency.
Okay. In the last fortnight or so, KPIT Tech was in the eye of the storm, so to speak, right? After that JP Morgan downgrade came in, they spoke about de-rating of the stock as well because perhaps of the scarcity premium going away with Tata Technology IPO being announced. But for a long-term shareholder, what do you do now if you've sort of made money in KPIT Tech, but now these uncertainties have cropped up?
So while we don't cover KPIT, it's not in our coverage, but what we can talk about is the industry tailwinds in the auto ER&D space, which is certainly a big growth driver for some of the peer sets, be it a Tata Elxsi or be it an L&T Technology Services. So I think some of the industry tailwinds continue to remain. I think that remains unchanged. But broadly, if you're looking at the ER&D space, on a relative basis to IT services, valuations do seem a lot.
Okay, pleasure speaking with you, Apurva. Thanks a lot for joining in, and hopefully we'll get to chat with you again post the numbers come through, get a more nuanced analysis on the Q4 numbers. Thanks a lot. Well, for the market, very quiet. The Nifty is still up about 20 odd points, not going anywhere. It's a holiday shortened week, so maybe volumes could be on the lower side. We'll ask those questions to Mitesh Thakkar on the other side of the break, so don't go anywhere. Some technical trades coming through. Welcome back. Well, it's very quiet for the market, but the question we're asking is what happens to some of these stocks that are just soaring away right now? Mitesh Thakkar joins in. Mitesh, before asking you about the market, I want your thoughts on Tata Motors. When the market was opening, you said that yes, there is some more upside, and look at that, it's zooming now 8% higher. Is the risk reward still favorable at this 470 price?
Okay, so Sonia, I think I'll answer this question slightly differently. In the short term, maybe not, because 485, 480 zone is some kind of supply pivot. But what is interesting, and I want to add a disclaimer here that I bought some stock today morning. What is interesting here is that the long-term charts now could be possibly shaping up for a start of a fresh up move. We saw Tata Motors price peak at about 530 levels, which was way back in November of 21, and it's about a year and five and a half months since then. The stock was basically correcting and consolidating. So I think the positive signs on the long-term chart suggest that once this 480, 485 hurdle is cleared, it should head towards 530, 540 zones, and then beyond that, maybe 600. So I'm very, very positive on the long-term chart. So if you are looking to accumulate, yes. But from a trading point of view, because we've already seen a rally of about 8% today and 480, 85 is some kind of a historical pivot, we made a high around those levels in August, September last year. And therefore, you will see some profit happening over there. This may not be the best entry point if somebody has a less than a week kind of a trading price. But coming to my stock picks, I have two buy calls right now. MGL is something which is broken into fresh highs. So 999 being the stop loss here, buy this one. for targets of around 1,060. And L&T, which was a recommendation last week as well, continues to go higher, still showing strength. So that's a buy with the stop at 22.95 for targets of 23.60.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's focus on a couple of stocks that are moving around. And Shobha, that one's popped up in trade. Sonal joins us to give us a quick rewind of what she told us earlier. Sonal?
Well, yes, the real estate pack entirely is doing really well, and Sobha is one of them, high by around 5% because it reported good quarter for operational update. In fact, it was the best ever quarterly sales reported by the company. Bengaluru was the one which saw a flat YOY growth. However, it was Kerala which saw good growth, but NCR this time around saw a dip for the company. In terms of the numbers, sales value in terms of Sobha shares, that was up 26% on a YOY basis. Sales volumes came in at 1.47 million square feet, which is an uptick of 8%, and realizations also up 14% on a YOY basis. As I said, Bengaluru sales this time around flat on a YOY basis at 0.92 million square feet. NCR was lower at 0.18 million square feet, and Kerala, which is the new geography where they are expanding, is at 0.16 million square feet for the company. They launched their first ever project in Hyderabad this time around, and overall launched 3 projects with saleable area 1.06 million square feet, which will come up in sales in the next coming quarter. So yes, overall good set of numbers here.
Okay, good set of numbers coming in there, 5.5% higher. People buying more homes, they're perhaps buying more watches as well. Titan is on our radar. Mangalam will tell us why. Mangalam, over to you.
More watches and more gold, as well as more saris. That's what people are buying in Titan. You know, the strong the fourth quarter update, especially in light of the environment that we're in right now. 23% growth in their jewelry business. That, of course, comes on a low base. Same time last year, because of Omicron-related issues, the jewelry business grew by 1.3%. What really took your breath away this time around was the non-jewelry businesses. 41% jump in their watches business. Also emerging businesses, which include fragrance as well as fashion accessories, growing almost 84%. Tanera saris growing by about 208% too. Overall standalone revenue for the company up 25%. A 59% growth is what we saw in their Carrot Lane business too. March, however, saw some softness on account of a sudden spike that we saw in the gold prices, and to that brokerages have written. Macquarie says that, you know, they believe that the demand softening in March will actually reverse now that we're in the first quarter, and also demand at lower price points, which seem to be a bit of a concern, is reversing, though they have an outperform rating with a target of 32.50 on the stock. And Goldman Sachs also says that despite tough macros, the company has reported a stellar growth, and that remains an outlier, as a result of which Titan is their only buy that we have in the discretionary consumer sector, and they too have a target price of 3,175. So brokerage is happy, resilient growth coming in, stock up 2% plus.
Okay, who are these people? People are buying more houses, they are buying more gold, they are buying more saris and more cars.
Wow. Good to see. I mean, I don't think I'm part of any of those lists, but be that as it may. But the other big mover actually today is Credit Access Grameen. Abhishek, you know, before we went into this long weekend, Chola was up and about. Today you have Credit Access Grameen that's flying away.
Well, disbursals is the talk of the town for entire NBFC or banks as well. So disbursal growth has been strong for Credit Access Grameen, up about close to 24% YOY and 48% quarter-on-quarter. The AUM growth is about 27% YOY and more than 18% quarter-on-quarter. Now take this loan growth with a pinch of salt, given the fact that in the EMI portion that they pay, there are 2 components, interest as well as principal repayment. My calculation shows that there is slowdown happening in the principal repayment, which is actually aiding in the loan growth, and higher proportion of interest outgo is keeping the book standard as well as guiding the yield factor. So calculation shows that average ticket size is up 12.3% YOY and about 18.25% quarter-on-quarter. Now remember that sequentially the number of clients have remained flat for Credit Access Grameen. Back to you.
Okay, Abhishek, thanks a lot for that. So that is Credit Access Grameen. The market, by the way, is inching up minute by minute, but nothing great to report home. So let's do one thing. Let's take a break. On the other side is our special segment. It's the economy. Lata will get chatting with K. Ramakrishnan of Kantar, Mayank Shah of Parley Products, and Akshay D'Souza of Bizom to decode the demand trends in the FMCG sector, whether there's a pickup in this year so far. Stay tuned.